More Business Briefing right now on FM News 101.
And moving past the bottom of the hour now here on Business Briefing. Welcome back to the show. Glad you could join us, and we want to continue our conversation with our accounting expert, Michael Lortz at Geffen in Portland. We're getting more and more feedback, if you will, from business owners and executives, particularly boomer business owners who were looking to sell or exit their business 2006, 7, 8, and obviously it didn't happen for many of them due to the Great Recession. Now the economy's back, and more boomer business owners in particular are looking at that exit. And let me tell you, you want to start the process early. The biggest mistake that most business owners make is not starting early enough. I talked to Michael about that and much more at his offices in downtown Portland. Well, Michael, several ways to structure these sales. We talked about C Corporation electing S Corp status. That's obviously makes a huge impact when it comes to dividends, but there's other things to consider, right?
That's right. So, the government has a vested interest in making sure that you don't simply grow a C corporation into a very valuable company and then escape this double taxation simply by making an election. And so there are rules that essentially force you to still pay the C corporation tax if you dispose of the company's assets during a certain period of time after making the election. The rule is 10 years. So believe it or not, you would want to make this election and then wait to sell for 10 years. That's a really long time horizon. What I tell people, though, is, look, if you don't know exactly when you're going to sell, let's look at the impact of making the election. And if the impact wouldn't be significant in the short term, start the clock ticking. Who knows when you'll actually sell? Remember, rolling 5 years happens all the time. Yeah. Second, there's been multiple instances in recent years where Congress has shortened that timeline down from 10 years to shorter time periods, 7, 5, for example. And you don't know what the rule's going to be when you eventually sell your business. So again, you need to do the analysis. If making the election is a no-brainer, do it. Get the clock ticking.
Michael Lortz, Geffen joining us here. And we talked before the interview about the structure of an equity sale versus an asset sale and how that can be beneficial. Why don't you touch on that?
Sure. So when a company sells its assets, the company has a gain. So if it's a C corporation, for example, if it sells its assets for a gain, then the corporation has taxable income. And that's what results in this double tax, because the corporation pays tax, and then when it distributes the remaining monies as a dividend, then the individual shareholder pays tax. But this concept of an equity sale versus an asset sale is also relevant for other entity types, say S corporations or partnerships, for example. Because when you sell the assets of a company, oftentimes a portion of that sale could be ordinary income if the assets of the company would normally produce ordinary income. If you simply sell your equity in a company, depending on the circumstances, a significant portion of the sale could be capital gains. In fact, under some scenarios, it would all be capital gains. So there can be a tremendous tax difference to the seller depending on how the sale is structured. However, buyers typically have the opposite interest, the opposite motivation, because of their own tax ramifications. And so this is often a negotiated item.
Let's move on and play off that now in an equity sale for our listeners in the Portland market. Many of them pick up and just move across the river into Vancouver. I know a few people who have moved to Seattle. That seems to be pretty popular if you're looking at an exit.
That's right. It's certainly a discussion we have all the time. And, I'm to be honest, I am often surprised how many people do not do this because of either loyalty they have to the state or perhaps they have children in schools, etc., and don't want to uproot their families. So it actually happens, I think, less than the general public perceives. However, there are situations where people do execute that strategy. It can save a lot of money. What we find is that if people are going to take that approach, they need to take it seriously. They can't simply pretend to give up their Oregon residency and pretend to live in Vancouver or the state of Washington. It's got to be a real residency change, and there's a number of things they need to do to make that happen.
Well, let me tell you, if you move to Washington, the revenue department up there, they'll find you too, because they have B&O tax up there, so they'll find you real quickly. Promise you. Personal experience. Redomiciling a holding company, I mean, how difficult is that? I mean, you pick up and move your personal residence, but I mean, is it easy to move the business as well?
Yeah, some of our clients have what I would call a more complex entity structure for their business. So rather than just having one business entity, perhaps they have a holding company that owns multiple businesses. Perhaps they own businesses and real estate. So one of the things we try to do is we try to make sure that when somebody sells an asset, that where the holding company is located doesn't cause more tax. So an example would be in the city of Portland. You might have an equity sale, but if you've got a holding company holding the assets that are sold, the companies that are sold, and that holding company is based in the city of Portland, well, you might unwittingly subject yourself to that city of Portland tax we talked about earlier. There might be a legitimate way to redomicile that holding company into another jurisdiction. And so we take a look at those opportunities.
Michael Lortz from Geffen joining us. Last thing I want to touch on, and really just touch on it, is the Delaware Statutory Trust. I know business owners hear about that. It sounds intriguing, but it's pretty complicated.
It is. The concept there is an asset protection trust, and many times these trusts are formed for non-tax reasons. People put them in to protect assets from creditors that don't have a claim currently, but creditors that might arise in the future. One of the challenges with this structure is that when you put assets into these types of trusts, your ability to access those assets can be limited. And there is a technique that has been used in our marketplace whereby folks put their business interests into these trusts and then attempt to escape state taxation when the transaction actually happens. It's a somewhat controversial technique. Different professionals would give you different opinions on it. Regardless, if it's something someone's interested in pursuing, that's the sort of technique that would need to be looked at well in advance of a transaction.
All right. Great insight as always, Michael. Thanks for joining us.
Thank you.
And again, our thanks to Michael Lortz, CPA and shareholder at Geffen in Portland, working the Portland, Oregon, Vancouver, Seattle markets up and down I-5. If you'd like to reach out to Michael, his email is mlortz@gmco.com. That's MLORTZ@gmco.com. Direct line 503-445-3368. Of course, Geffen, one of the most respected firms, not only in the region, but the entire country. And this is an interesting topic, too, for those of you boomer business owners just joining us here as we move toward the top of the hour. If you missed this segment with Michael, in fact, the past two segments, those of you across Puget Sound, Seattle, Tacoma, podcast on mynorthwest.com. In Portland, Vancouver, visit kxl.com, because vital information here. I think the biggest mistake business owners make is not starting the planning process early enough on the exit, not getting the books in order. That's not to say you don't already have them in order, but really getting things cleaned up and working with your CPA and your attorney, perhaps a business expert, on exits, to really plan this out. The runway can be as long as 3 to 5 years, as quick as 1 to 2 years. But really, most of the experts, including Michael Lortz we talked to, always tell us to plan ahead. So important. I think that's the biggest mistake most business owners make. And it'll be interesting to see, with so many boomer business owners heading for the exits here in the next decade and beyond, who will buy these businesses? I know there's a ton of private equity money flooding into the region right now. The floodgates have opened in that regard, which is good. Who are the buyers? Will all of the private equity firms be interested in all these, for the most part, small businesses? It'll be an interesting thing to see this play out, because Gen X coming up behind the boomers, well, quite frankly, there's not a lot of money there at this point for Gen X business owners to pick up boomer businesses. So we'll see how this plays out over the next decade. Going to be very interesting, but timing is the key, no doubt, when it comes to business.